everybody. Welcome to ClearVista Financial Perspectives, February 2025 market update. We made it to February. Welcome. We have a great presentation for you all today. We'll be focusing on the performance of our main indexes in January as usual. And of course, we'll do a deep dive into what's going on at the Federal Reserve. And also we'll talk about the macroeconomic environment as well. And how does this impact you? We always want to make this relative to our listeners, to our clients, to our friends, anybody involved here. As always, you can participate with us by sending us a message at 254-282-0495. That's our text line. If you want to send us a text here, we'd love to respond to you on that. And then also, we have info@clearvistafinancial.com. That's our email. You can send us a message there if you like. So let's go ahead and get started. Sorry, here's our agenda for the day. That's 254-282-0495. All right, first up is the S&P 500, the large cap index. On the right is the candle chart, where each candle represents a trading day. And green candles are positive days and red candles are negative days. And a stem, or the wick of the candle, the kind of the long point on either end of it, is where the price went throughout the trading day. Just a little reference there on what a candle chart is for you all. So this is the S&P 500, our US large cap index, weighted by the size of the company. The index was up 2.7% in January, and it swung 4.11% from the 6th through the 13th of the month. You can see there the kind of the peak in the first week, and then it came back down, and then it was positive 6.15 through 113 through 125. And we did have a new high of 61.18 on January 23rd last month. Next up is the NASDAQ 100, which is our tech-heavy cap-weighted index that does not include financial companies. As expected, it behaves similar to the S&P, but with a little bit more volatility. And it ended up gaining less than the S&P at 1.64%. Notice the 3% gap there on the close of Friday the 24th and Monday the 27th. We'll talk about that in a minute, but that was the day that markets reacted to the tariff situation. We were, throughout the month, if you were curious, we were minus 5.88% swing, and then it rose quickly 6.83. So tends to be volatile in this index as usual, nothing out of the ordinary. Next up is our Russell 2000, the small cap index. It was positive 2.5%, but here we're still recovering from December. If you all remember, we had a 11% drop due to some speculation of the Federal Reserve in December of last year. Notice how this chart is wider and shorter than the other charts. This index generally moved sideways, although it did close positive for the month, but kind of a different shape here on this index. Next is the long-term Treasury bond index. This index was pretty much flat, positive 0.49% for the month of January, and is also still recovering from December. This index is struggling to improve despite a yielding curve that is uninverting. I'll show you all the yield curve here in a few moments. And then lastly, of course, our moderate index, which is what we compare to a balanced or a moderate investor. This was plus 1.47%, benefiting mostly from a large cap index, the portion of the index here, and then held back by long-term bonds. So I'll take a minute here. I don't have any music for you all, but here's our disclosures for the indexes. All right, thanks for taking a break there. So here's a chart that shows the look back of the last quarter of 2024, comparing the indexes of different size companies, and then the international index is in red. You can see that the white line is large caps, the S&P 500, and it ended up on top. And then international has struggled in terms of relative performance over this period. I just thought it would be interesting to compare companies of different sizes over the last quarter of 2024. Of course, we had a pullback in the market, and this isn't showing um, the index performance per se, but it's comparing all the different company sizes. Here's the same chart, but it goes back 2 years. So it provides a lot more insight and perspective. But I want you all to focus on the yellow line. I know it's kind of hard to see, but the yellow line is the one that starts off on the bottom in 2023 and closed just above the red line over this period. This is the small cap index compared to the large cap index in white. And this really tells the story of the big companies, specifically 7 to 10 of the mega cap companies that you all know very well. You're probably watching this webinar on a device created by one of those mega cap companies. They've been leading the way over this period. So notice how small caps are lagging. We've been talking about this for actually a couple of years now, but in a market that's been characterized as very bullish over the past 2 years, small caps continue to lag. We've been seeing this for almost 3 years when we're comparing large to small, and we really want to have improved market breadth comparing these two. And we'll continue to watch this as we go into 2025. Lastly, the international index in red is the clear loser over this period when it comes to equities. And it's an important part of a well-diversified portfolio, some might argue, but we're not seeing the same level of leadership compared to more domestic companies. Here's our seasonality chart that I always like to bring up. This doesn't mean that we're headed for chaos in March, but you can see the red arrow there is where we are in the middle of February. Seasonally, we're headed for maybe a slightly elevated volatile time, but not nearly as high as March tends to be. And based on this, it tends to calm down in the summer, but with all the factors we're dealing with right now, that might not be the case. I wanted to make a point here about the top heaviness of the large cap index, specifically the S&P 500. There are 4 companies in this index that are valued at or above $3 trillion with a T, and then 4 more in the $1 to $2.5 trillion range. And this is a historically high level of focus on the biggest companies in the country. The top 10 companies in the S&P currently make up 40% of the market capitalization, give or take. This means that 10 companies are 40% and 490 companies are 60%. So let that sink in for a second. 10 companies are 40%, 490 companies are 60%. That's how skewed we are towards large companies. And I've said before how one of these companies alone in the $3 trillion range has more market value than the entire Russell 2000 small cap index, all 2000 companies. So historically, this is a very top heavy structure. Over the past decades, this has been closer to 20%. Here's a chart that I created a few months ago, but I really like it, how it tells a story of where we are now. This is going back to 2020. You can see I put COVID-19 there. We saw a sharp drop off in, this is the S&P 5, or no, sorry, this is our moderate index. And then we had the stimulus rally. Everybody had cash in their pockets and the markets rebounded quickly. And the bear market of 2022, where most people took a hit and kind of hid in their caves and refused to look at their statements, even though they were losing money. A lot of people lost quite a bit of money, especially if you were holding long-term bonds and equities during that period. 2023, we didn't know when it was going to recover. We ended up seeing a nice run in the last quarter of the year, but other than that, we had a really volatile sideways year. And then leading into 2024, we had all the hype and excitement around artificial intelligence and the Mag 7 or Mag 10, if whatever you want to call it, continued to increase in size and performance over that period. And then at the end of 2024, we had a pullback, and we're still fighting our way back from that pullback. Here's a red line of where we closed at the end of 2024, and it just kind of tells the story of why some moderate style investors are still struggling to reach new all-time highs in their portfolios. We will take a shift here to pause, and we're going to move into our macroeconomic review. But I also wanted to remind you all that you can interact with us if you want. 254-282-0495. If you have a question or a comment, we'd love to hear from you. All right, let's try to gain some perspective on the economy and the interest rate environment. In January, the Fed met, and their official stance was wait and see, no change, or a pause. This is, of course, following a 100 basis point rate cut in the end of 2024, or the back half of 2024. And that wait and see stance is for the foreseeable future. Starting with the FOMC statement, there were some language that were noteworthy, that's different, some different language here. On the employment front, prior comments that labor markets have eased and the unemployment rate has risen. Now they're stating that the unemployment rate has stabilized and labor market conditions remain solid. With regards to inflation, the FOMC removed language noting progress toward the 2% objective, and now they simply state that inflation remains somewhat elevated. So we are higher than the target 2%. Both of these stances suggest more hawkishness and, at a very minimum, less dovish news for the investors and the people with actually dollars on the line. If there was a consistent theme here, Powell stressed throughout the press conference that the Fed believes that their current stance is positioned to respond to the data when it is demanded. And I know that that's just Fed speak for we don't really know what to do, so we're going to do nothing. But it is worth noting that the FOMC previously expressed confidence in their policy stance back in 2020, and not trying to call anybody out here, but they felt that any rise in price was from massive government stimulus. Remember when they were saying the word transitory? Well, now it's anything but transitory. It's 2025, and we have learned that that is not the case. Here's a visual for you all on the right that shows where the actual rate is as of the policy no stance change. Here's a historical chart from the St. Louis Fed of interest rates since 2022. On the far left, you'll notice it's almost zero. That's back in the day where you could get a 1, 2, 3% car loan, you could get a 2 or 3% mortgage, and money was cheap and easy. And you can see how quickly they increased that rate all the way to the middle of 2023, where they held it steady for a very long time, almost a year. And then on the right, you can see the progress that we've made so far. So there was the jumbo 50-point cut in September, and the quarter point in November, and the quarter point in December. So that brings the Fed funds rate down a full percentage point, or 100 basis points, which seems like a lot. But let's look at the chart here, and you'll see that respectively to the past, it's not that much, and we have a long way to go. Here's a Fed funds rate since 1973. Just for those of you all who think that we're in a state of financial chaos, historically, we're actually lower than the average just because of the extremely high rates in the 70s and 80s. Back in 1980, you can see that the Fed funds rate was at 20%, meaning if you wanted a mortgage, you're talking about 22, 23, 25%. You could also get 20% on a fixed CD or something at the bank, but that's the tightest that we've ever seen it compared to today's. I think it's 4.5 to 5% range. It's actually, yeah, 4.25 to 4.5%. So not nearly as high as we've seen in the past, but still high. Good news here. We always look at the yield curve, which is the left is short-term rates and the right is long-term rates ranging from 1 month to 30-year. These are debt instruments issued by the Treasury, the federal government, and it's finally healing, if you will, or correcting. It's turning into that hockey stick shape that we'd like to see, versus for almost 3 years, it was completely inverted. You'll notice the 1 month yield around 4.3 and the 30-year yield around 4.8. So we still have a lot of progress to make, but at least the 30-year is currently higher than the 1 month. And also the really important figure here is the 10-year, which is closely tied to Americans who borrow money, and that rate is just above 4.5%. So that's going to be a lot of your mortgages and debt instruments that you and I actually use. We got GDP data since we talked last. Um, Real GDP increased at a 2.3% annual rate in Q4 of 2024. That actually lagged the consensus, though, of 2.6%. The largest positive contribution here came from personal consumption, with a sizable gain from government purchases as well. So GDP is rising, but it's coming because we are spending more money and the government is spending more money as well. On the personal side, do we actually have that money, or are consumers just laying away more debt that they can't pay right now? Inventories were a drag on growth, and as business investment in equipment and commercial construction also declined. So not the greatest sign there as far as the actual numbers behind the growth. And then the GDP price index increased at 2.2% in Q4 at an annual rate. That's up 2.4%. And then the nominal GDP, which, if you remember from Economics 101, is real GDP plus inflation, rose at 4.5% annual rate and is up 5% from a year ago. So this is what everybody cares about right now, is inflation, tariffs, and the Fed. We already talked about the Fed. I'll mention a few more comments here, but clearly Trump and his tariffs have had an impact on the stock market. So we saw multiple days this month where indexes fell overnight because something happened in the news and the headlines that caused investors to get scared. The Federal Reserve made it clear, we already talked about this, that they're not cutting short-term interest rates anytime soon. That's actually good news if you want to see the Fed live up to its goal of bringing this inflation that we're dealing with down to 2%. And progress on that has been stalled. The PCE price index, which is the Fed's measure of inflation, increased 2.6 in 2024, barely better than the 2.7% climb in December 12 months 2023. So core prices, which is where we get rid of food and energy because they're very volatile, climbed 2.8% last year. So those are some comments on inflation. Let's talk for a second about what they call super core prices. That excludes food, energy, some other goods, and housing rents. So we're looking at the real impact on American purchasers, people who are spending money. This rose 3.5%, and in 2024, it rose 3.4%. So you are correct that super core inflation was worse in 24 than 23. So let that sink in for a second. The actual measure that affects you and I in many ways was higher in 24 than 2023. So we like to pay attention to this measure, not because we think it's a great inflation tool, but because the Fed was telling investors and the general public to watch it. But then they mysteriously stopped talking about it when it didn't tell their story anymore. So just a quick comment there. Let's move on to tariffs. Um, we are dealing with rising tariffs. We're talking about Canada, Mexico, and China specifically. Each of these countries is saying some sort of retaliatory tariffs are on the way, and that's what's got the markets worried, going both ways, and how this will affect inflation. This is often misunderstood. We have to take into account the monetary policy that we're in right now, which is still tight, according to the Fed. Ultimately, inflation is a monetary phenomenon. And as long as the new tariffs are not accompanied by looser policy, meaning more loose policy from the Fed, um, inflation will be less reactive to incoming data. So keep this in mind when you see an onslaught of economic reports over the next few weeks, and just keep a close eye on what the Fed says. Um, the Fed might begin to use this as an excuse for keeping rates high. And according to some of the economists that we study, this could mean the era of easy is coming to an end, especially if they continue to be more hawkish. So let's take a step back here for a second. How does this really impact you? We have tariffs, we have tight monetary policy, we have somewhat resilient markets, we have potential stagflation on the way. And how does this affect you? Well, as always, we don't have a crystal ball to tell you what's going to happen in the future of the markets or the economy, but these conditions in the past have led to a recession every time. And this is different. There's a lot of different factors. We had a pandemic, we had unprecedented stimulus from the government. We do expect a recession. In fact, we know a recession is coming. It's just, when is that recession coming? A recession is a healthy part of every economic cycle. But let's be clear here, recessions give us hope that prices will return. It's a normal process. If we're talking about a bubble, bubbles give us less hope on whether these prices are going to return. So, not that we welcome a recession, but it's a part of the economic cycle that we are expecting. Here's a summary of our comments so far. Wait and see from the Fed, of course, just means we're going to stay here for a while and see what happens. Market breadth not improving. The large cap companies continue to dominate. Bond index, they're struggling. They're still not recovered from where they have been in the past. Interest rates remain high. For those of you trying to maybe purchase a home or looking at auto rates and things like that, they're still high. Credit card debt is high. People are spending money that they don't have, which is stimulating the economy. Personal money supply is lower than it's been over the past couple of years. Whatever money people had, they are spending it. And then now we have the political pressure of tariffs, which it seems like most of the real negotiation has been pushed off about 30 days. This gives them a lot more time to dig into the details and see how they could possibly create a mutually beneficial relationship. But At the same time, it could have a major impact on the inflation environment. So what's our solution here? It's the same as always. Be sure that you and your advisor have a strategy for how to navigate this volatility. There are clear winners right now. There are clear losers right now. And you just need to be talking with your financial professional about what are we doing to capitalize on that and also protect from potential downsides like an oncoming recession at some point. We don't know when that's going to happen. As always, do not panic. So don't make drastic decisions with your money based on headlines or rumors or political actions. We encourage you to not make decisions based on emotions. I know that's difficult. That goes against our human nature. And of course, avoiding political bias in your decisions will be beneficial in the long run. We do believe that the future of the U.S. is bright. The economy will continue to operate no matter what policy or tariff comes into place. The economy will continue. Quick note here about your 401k. This is often a lot of people's main portion of their nest egg. They've been stashing away money in their company plan for years. We want to make sure that you're taking due care of that money, because a lot of plans have the flexibility for either selecting a wide range of investments inside the plan or rolling money out, or even doing self-directed brokerage options that can provide you with a lot more options. We're happy to give you a free consultation about that. We even have a tool that we're welcome to send your way where it'll actually just give you recommendations on what to do inside your 401k. So please take advantage of that. We'd love to help you all. If you do have a large portion of your savings inside of that plan, we can help you. As always, check your statements, get help from a professional, and educate yourself. I hope you have been able to learn something through today's webinar and also through all of our webinars. We have education ongoing. You can check out our website, ClearVistaFinancial.com or SpendLifeWell.com. You can find lots of material there on how to educate yourself. We want you to be educated so you can make wise decisions. I'm going to take a second to check if we have any messages. Looks like, here, I'll turn my camera back on. You all can see me. The main thing that people are worried about right now is, from the messages, the mortgage rate environment. And I wish I had a crystal ball to tell you in 6 months it'll be down below the 5s or in the mid 5s. I just don't expect that to happen, because the Fed has said that at most they will cut twice this year, a quarter point each, and that's a maybe. So at best, we're talking about a half point drop this year at the Fed level. And by the time that trickles down to people who are actually interested in purchasing a home, it might be a little while. I don't want to be all gloomy news here. You know, historically, the rates that we're at right now are pretty much average. And I know that lots of people are used to 2.5%, 3% mortgages in the 2020 or earlier range. And I think it's going to be a while before we see that, unfortunately. It could be 5, maybe even 10 years before we see that go that low again. So for those of you asking about that, I hope that helps. Happy to schedule a call sometime if you want to learn more about that. Otherwise, thank you so much for participating today. Here's some of our contact information if you want to call our office during business hours. Our 800 number is there. We're happy to talk to you about your situation, or just talk about the current state of the economy. We love having those conversations with people. So thank you so much for joining us, and we will talk to you soon. Bye.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.